Good afternoon, morning. I'm not real sure what time it is, but this is an exciting panel, and I'd like to thank the Capital Link guys so much for asking me to do it, and all of our panelists here for agreeing to hang out with me for a little bit. There are facets of the Jones Act, but I think probably the one that people are the most familiar with is what we're going to be talking about today. And also we were talking just a few minutes ago, things have changed an awful lot in the last year for the better as it relates to the energy shipping in general within the Jones Act, but certainly the tanker market and the barge market. And we're going to be diving into that a little bit. To maybe start us off, if we could have each of you guys just tell a little bit about yourselves and your companies. I'm sure you can do a much better job of that than I can. So just based on my screen, Sam, if you want to lead us off, and then we'll go Dan and Christian, and then get to the meat of the conversation.
Thanks, Ben, and thanks for having me, and thanks to Capital Link. I'm Sam Norton. I'm the president and CEO of Overseas Shipholding Group, also known as OSG. We are a principally Jones Act operator of tankers and articulated tug barges. We have vessels that operate on the West Coast, bringing crude oil from Alaska down to the refinery bases in Washington State and California. And we have a principal operation of product tankers, moving refined product from Texas and Louisiana into Florida and the East Coast of the United States. We have some specialized businesses. We have 3 vessels that trade internationally under U.S. flag, under certain Transportation Department programs. And we have 2 shuttle tankers that operate off the FPSOs in the Gulf of Mexico. And we have a lightering business that runs lightering operations into the refineries in Delaware Bay.
All right, Dan, you're up.
All right, thank you, Ben. Good to be here with the panel, and thanks to the Capital Link guys for putting this together. Should be an interesting chat today. So I'll speak on behalf of Sibo Tankers, which is a significant piece of the SEACOR Holdings group of companies. Sibo Tankers is based in Fort Lauderdale, Florida. I'm the president and CEO of that business. We have 2 core elements to our Jones Act tanker operations. One is the traditional product tankers, MR type, and large ATBs moving both crude and products along the Gulf Coast and West Coast. And then we also have a slightly more specialized element to the Jones Act tank vessel business, which is providing services to parcel chemical customers, typically moving products from the Gulf Coast chemical operational areas up to the East Coast consumption areas.
All right, Mr. ONeill.
All right, Ben, thanks for having me this morning, and thanks to Capital Link. It's good to see you all. Looking forward to our visit today. I'm Christian ONeill. I'm the president of the Marine Transportation Group at Kirby Corporation. On the marine side at Kirby, we operate the largest Jones Act tank barge fleet with an inland operation running about 1,050 tank barges, 270 inland towboats, and offshore we operate 29 offshore units, mostly articulated tug barge units. On the inland side, we ply all the waters in the United States, the Mississippi River, its tributaries, all the way from Brownsville, Texas to Port St. Joe, Florida. We run up to Chicago, up to Pittsburgh, along the Ohio and the Illinois. In our liquids business, we move everything from the lightest chemicals, pressurized chemicals such as propylene, butadiene, things like that, to the heavies of the heavies, asphalt, crude oil, and everything in between on the refining side and the chemical side. We also operate in several niches. We have an offshore dry cargo business focused on moving coal and sugar. We have a joint venture with Cooper T. Smith where we move overweight and overdimensional heavy lift type cargoes. That company's called Osprey Line. And that company also pioneered the movement of containers on inland barges. And we own and operate a shipyard in Houston, Texas called Sanjak Marine, where we are at present building the first battery-powered electric hybrid inland tug. That's the high points on the marine side. We also have a diesel engine service business that's got some size to it, and we focus on repairing marine diesels and many other industrial diesel engines and distribution of diesel engines as well.
All right. That is a good overview. Appreciate that. So I'd mentioned that the market has improved a lot. I think that's a combination of supply and demand, and I think that's where we'll start, because ultimately, at the end of the day, that's what dictates pricing in these markets, the combination of supply and demand. So let's start on the demand side. I think clearly demand has been pretty good, but maybe if we can dive into some of those elements a little bit of what is driving demand, and maybe we could just start with from a high level perspective, saying, all right, well, the United States is producing a whole lot more oil than it used to be, and what are the implications for how that oil is moved around the coast and within the inland waterways, and how are you guys thinking about that is a driver for your respective businesses going forward? And feel free, this is a first come, first serve. So whoever wants to go.
Well, I'll give it a kickoff here, Ben. I think you're talking specifically about crude oil production and how that. So I think Christian may have some inland views on that. The pipeline infrastructure is far more built out today than it was in the last peak of the Jones Act demand cycle several years back. So crude oil production, in my mind at least, is not as much of a driver as it used to be from the demand perspective. The good news is there are new fuel requirements, and I'm sure we'll talk about renewable diesel later in this panel, and also just general rebound of consumption, particularly in the core Florida market, which is a big market for tonnage in the Jones Act to serve, rebounding from the lows of the pandemic. So when I think about the demand drivers, it is less about crude, not that doesn't have a role, and I'm sure others on the panel will have some views there, but a lot of the incremental demand has come, interestingly, from other parts of the demand structure.
And if I can jump in, I would concur with Dan's view on that. I think one of the most interesting aspects about the U.S. energy markets over the last decade has been the much more clearly integrated nature of U.S. energy markets with the international markets. If you go back 10 years, virtually no crude oil was being exported. There was an export ban on crude oil, in fact, until 2016. LNG was not exported at all. What LNG was moving was, and the facilities that were being built for imports. And even in the product markets of U.S. refineries were relatively underrepresented in international product markets. And you fast forward 10 years to today, that's radically changed. I would say somewhere between 30 and 40% of all energy produced in the United States today is targeted for exports. What that means is that whereas 10 years ago, producers in whether it be crude or its product or even gas in the United States, when they're looking for markets for outlet, they were much more dependent on Jones Act to be able to deliver the transportation needs to make that product get to market. Today, those options are far greater than they ever were in the past, and that makes, in a funny way, that makes the Jones Act, in my mind, competing much more with international markets than it ever did in the past. Florida is a good example. Florida is an island from an energy point of view. There are no refineries. There are no real pipelines to mention to bring product from the refining centers in the Gulf of Mexico into Florida. So everything comes into Florida by sea. And now that means that if somebody wants to sell a barrel of oil from Houston refinery into Florida, they can also look elsewhere into the international markets. And if the price is better in Rotterdam or in Chile or in Brazil, then that barrel is going to move to the better market. So I think the interesting development for our business has been that far greater integration of the energy markets into the international markets, and the implications on us in terms of how product moves and how our customers are looking to to retain flexibility to be able to do one or the other, import, rather sell domestically or sell internationally. And I think that's something to bear watching in the future. In recent months or the last year, that implication has positively affected the Jones Act because the international markets have in fact been very robust. And that makes the Jones Act look a lot more competitive. And I think that's led, in my opinion, that's led to a number of our customers looking to take cover for longer periods to be able to secure that capacity. Christian?
Yeah, a couple thoughts around crude. I think about crude oil and what it's done for the Jones Act demand dynamic, and I would agree with Dan and Sam that on the offshore side, you saw the peak in the heyday of crude transportation offshore, and with the lifting of the export ban, you do have the global competitiveness of shale tight oil. And I think what you see now is the global super majors highly focused on this highly advantaged crude oil that we have right here at home in America. And I think you're beginning to see less of the world scale, deep water, heavy investment in those types of projects. And you see really the flexibility and the affordability of tight oil. So what does that do? I'll just put the Kirby hat on. When you're exploring for tight oil in some of the basins that we service, it does create inland barge demand. And we do see that. However, crude oil is a fickle mistress, and it will, crude will find cargoes that move in a homogeneous spec in very large volumes. At some point, we'll likely find a pipeline. It just the economics do make sense. However, we find ourselves on the inland side still having pretty robust pockets of crude oil demand from some places where the pipes haven't quite gotten to, the pipeline infrastructure hasn't been fully developed. I may go beyond your question here and begin to just think about how advantaged we are in the refining and petrochemical complexes to have this much abundant, affordable crude right here in the United States. And so what I think that sets up well for everybody in the Jones Act is not just the physical movement of crude, but just how competitive we are globally in taking that crude and turning it into, all the byproducts, whether it be refined products or some of the feedstocks that go into the chemical markets. And so I think what we really set up is just a cost advantaged infrastructure that's going to be here for a long time, that's going to really help the Jones Act, directly and indirectly.
That's real. Honestly, that's where I was headed or thinking about with respect to that question is longer term implications. What does it mean that we have a competitive feedstock for all of that? I mean, nobody uses crude oil by itself. We're all using some derivative of it. And so it's just cheaper to have that initial crude oil barrel. What does it do for the transportation? And to that end, and connecting sort of more on the positive side of the underlying demand here, can we talk a little bit about, or what does that mean in terms of new products that might be moving around? Here, Sam, you talked about, I think it was you talked about biodiesel, which it doesn't even come from crude oil in the first place. But how are you seeing what your customers are asking you to do changing from a demand perspective?
There was Dan that brought it up, but I think that's the singular change in our markets that we've seen over the last 2 years. The advent of renewable diesel and other biofuels, but principally renewable diesel. You've seen, anywhere between probably 10 and 20 refineries announcing changes to their refinery mix to allow them to process the feedstocks that generate renewable diesel. Renewable diesel is super interesting in my view because it's diesel at the end of the day. It can be blended with diesel from 1% to 100%. It can move in the same pipelines. It can move in the same tanks without any special cleaning requirements. It's diesel. And the state of California and some of the other West Coast states are coming on. Washington, Oregon, maybe in the coming years, are providing significant incentives for use or substitution of renewable diesel for the basic diesel in their markets. And that's drawing a lot of the production that's centered in the Gulf of Mexico, where the feedstock sourcing is advantaged. The production that's coming out of the new refineries in the Gulf of Mexico is virtually all moving to the West Coast. That creates tremendous new ton mile demand for Jones Act vessels because it's a Jones Act move from a U.S. port to U.S. port, even though you transit the Panama Canal. And just to put it in perspective, a journey on one of our MR tankers from, say, Houston to Tampa is a 5 or 6 day round voyage. Into the East Coast, it's maybe an 8 or 10 day round voyage. If you go to the West Coast, it's a 30 to 40 day round voyage. So every ship that comes out of the traditional trades into Florida that goes into the West Coast is equivalent of 3 or 4 vessels. So that's taken a tremendous amount of supply out of the market. I count today somewhere between 6 and 7 ships that are committed to be able to do that trade. And that could expand another 3 or 4 ships, in my view, by the end of 2024. And put that in perspective, there's 43 Jones Act tankers that are involved in deepwater trades. So you're talking close to 20 to 25% of the total ocean-going tanker fleet could well be taken up in moving renewable diesel and its feedstocks from the Gulf of Mexico to the West Coast. So I think that's a super exciting development in our market, and one that offers a lot of optimism that the current balance in supply and demand that we see that has given rise to the healthier rates that we've been able to obtain in recent months. We think that's gonna stick for a while as long as that renewable diesel trade is sustained.
Yeah, building off a couple of things that Christian and Sam have said. You have this world. We're sitting at a pretty interesting junction in the Jones Act. You got world-class hydrocarbon production in terms of the efficiency of extraction, both on the tight oil and the gas side. You've got world-class facilities along the Gulf Coast, which have had significant inbound investment, which are still not fully ramped up, both on the petrochemical and the straightforward refining elements of the business. And you have a world where the reliability of supply has been more questionable than ever before, with the issues in Europe and other geopolitical issues that continue to bubble at or near the surface. And so when you engage with the folks that are in the business of either, and this is from my perspective, either in the business of getting parcels of chemicals to end users in the Northeast, or products into a key market like Florida, they will tell you that rateability and reliability of supply and the margins they can achieve, given their competitive advantage on the Gulf Coast, make the Jones Act the right place to take coverage and move and go long. And additive to that are the new requirements that Sam noted for RD. Renewable diesel also requires inputs, which effectively is used cooking oil and other soybean related oils that come in, and there's cargoes of that we now handle coming southbound. So we're also starting, when you say what are our customers asking of us, they're asking us to do more with what we have, go further, be more flexible, and they are definitely taking a much longer view, given the broad instability of or recognition of supply chain issues that were both COVID related, and then since COVID, I think more geopolitical related. And it's creating a very good atmosphere when we're engaging in pricing and term.
Yeah, I'll just comment briefly. They covered that quite well. I think what we're seeing, at Kirby is, you're seeing a growing emerging market in and around biodiesel and renewable diesel. It's a cargo we're moving. And on top of that, the feedstocks that go into it that'll come out of the Midwest will be a tremendous opportunity for us on the inland side. Those barrels of soybean oil and feedstock will see the Gulf Coast refining complex to be processed, and then hopefully put on an MR that one of these fine gentlemen operate and head through the Panama Canal to the West Coast and complete the circle. But it is absolutely a demand driver. It is still the early innings, but I think we're all moving cargoes today. It'll really be interesting to see, where it grows. California is where you can get the most money for a gallon of renewable diesel today. So the diesel that is produced is seeking that market, but as more of it comes online, it becomes more competitive. You know, there will be some other states and some other places where it'll seek, you know, the barrel will seek that market as well. It's exciting. We actually have several biodiesel trials going on at Kirby. We've been operating some inland tugs on B20, you know, for over a year now, and working in conjunction with a global super major. And we're also running an offshore unit on the West Coast with the B20 blend. And so it'll also be interesting to see where it goes in the marine fuel space and what we can do as operators to reduce our carbon footprint and mix it into our own operations and see what that does to drive demand as well. As you know, there's a significant marine fuel distribution network that you know, Kirby participates in, bunkering ships, transporting resupply of diesel and 2-oil. And it'll be interesting to see how renewable and bio plays a role in all of that. I think what you see now is some of the capacity that's offline, refining capacity. If you just want to think about, you know, the whole apple pie, today you have several major refineries that are being retrofitted to produce renewable or biodiesel. And it'll be nice to see that investment come online in the next few years, because that will actually be a very, you know, concrete, definitive new demand coming back online from refineries that went out of service. So those will be new barrels to the market, and that should help demand.
All right, that's fantastic. I want to finish up just keeping in mind that really half the story here, at least half the story, is supply. So I don't want to short that, but just the last little bit on demand. You know, I think we've talked about the positives. The negatives are, you know, increasingly people are driving electric vehicles. So what does that do to demand, or how you're thinking about demand going forward? And then from a more near-term perspective, does, you know, a U.S. recession keep you up at night, or is that something that you feel like you're pretty well insulated against? Maybe we'll go in reverse order this time. We'll start with you, Christian, since you've been last so far. Yeah.
So I get the EV question.
Yeah,
Thank you,
exactly.
Thank you. No, so I do have a view. Here is the good news. EVs will penetrate the market. They are coming. I haven't bought one yet, but they're intriguing to me. However, I do know that demand for diesel and jet fuel in the out years isn't going away. And if you want to squeeze the diesel and jet fuel out of a barrel of crude, you got to put the whole barrel of crude into the refinery. So you're still going to make gasoline, or maybe you can tweak your refinery to produce some other intermediates that'll seek markets. There globally, gasoline will find those markets. I'm confident of that in some of these, you know, growing, burgeoning economies in developing countries. You know, I also will tell you, for every EV that's built, you still need a console made out of plastic, tires made out of carbon black, upholstery and seats made out of, you know, polyethylene benzene or other derivatives of chemicals. And so for every EV that's built, including some of the components that go into the battery, you're going to see demand from petrochemical and petroleum related products. But I really do think, in my mind, the thesis, you know, goes to that you have to consume that whole barrel of oil still to squeeze the diesel and the jet. And I'm pretty sure that those cargoes are going to remain pretty resilient, well past perhaps, you know, whatever demand destruction we see in gasoline. But you know, we'll see how it all plays out. A lot of my friends here in Texas still drive big diesel trucks. You know, a few of them do have EVs, and that's great. But you know, we'll see where it goes. But I actually think that the thesis is, you know, is not as dire as once many people thought, when you consider that you still got to consume the barrel of crude.
Great. Any Sam, Dan, either of you guys have anything to add to that, or well, actually, real quick, are you concerned about Are you concerned about a recession? Are you not too concerned about a recession?
I say, Ben, that maybe a recession is more of a near-term concern just from the demand destruction perspective than EVs. The talking heads will go between a soft and a hard landing, or a no landing, and I think no one really knows. We sit in Florida, as does Sam, which is a big market for the blue water assets in the Jones Act. And for every EV, just building on Christian's comment, that I see 2 or 3, Dodge Rams or equivalents that are, not doing the speed limit. They're doing 50 miles an hour over it. So no one's worried about CAFE standards or miles per gallon in this state. And there is a political element to this, which interestingly, when you look at it, means more fuel keeps running into Florida and more renewable diesel keeps running into California. These are good things for the Jones Act. So I would be more concerned about a recession than any change in consumption patterns per se.
Right.
Yeah, I would even take a little bit more optimistic view from OSG's perspective. I concur. I think electric vehicle penetration will be visible over the next decade, but most cars are on the road for 10 to 20 years. I think the penetration of electric vehicles today nationally is like 5%. So you're going to still have a pretty well-established consumer base, and the jet and the diesel, as Christian has alluded to, is much harder to produce alternative fuels. They're much more expensive to produce those alternative fuels, and even if you do, those still have to move. So I don't really see that as a near-term issue. And from a recession point of view, I think our business right now is pretty well insulated from a recession. We have pretty good coverage on most of our ships, and there doesn't seem to be any real drop off in visible demand. Little bits and pieces here maybe, but nothing like we saw during the pandemic. I mean, the pandemic was really once in a 100-year storm. We saw consumption levels dropping 30, 40, 50%. And that just was devastating to anyone that's involved in the refining or distribution or sale of petrochemicals and hydrocarbons, including the shipping industries. We don't see anything like that coming back again, absent another pandemic or that sort of thing. Recession maybe reduces demand on the margins, but we certainly don't see anything like that today.
Right. Well, let's shift to supply, and I'm going to try to crunch some stuff together here just so that we don't run out of time. But first, I think it's important that we categorize sort of where we stand with respect to freight rates, vessel utilization, returns on assets, because ultimately, when those things get high, returns get high, freight rates are high, utilization's high, that's when you begin to see ordering. But tying this to sort of a two-part question here, I think there were something like 22 tank barges ordered all of last year, lowest ever, and I believe there are no MR tankers on order, and I believe there are no ATBs on order either. So we're in a place where unprecedented times in terms of nobody's ordering anything. Again, tying that to where freight rates are at the moment. I mean, is that clearly we've gone through a bad time, things are a little bit better. How are you thinking about that dynamic between returns and capital deployment? Anybody?
I'll jump in on the inland side first, and then we can talk a little bit offshore. So today, if you wanted to build a homogeneous 30,000 barrel tank barge, with the price of plate steel where it still is today, even though it's come down a little, and keep in mind it's a solid 200% inflated from where it was a couple of years ago. You're talking about a $4 million plain vanilla barge. The economics don't work even at today's rates, which are getting quite nice and continue to increase and rise. Couple that with the fact that if you're going to build a new towboat in this market, you're going to have to put Tier 4 engines in it, unless you laid a keel a long time ago. And almost those keels have been consumed and built out. So you're now facing a $4 million inland tank barge coupled with an inland tug that you're going to have to put Tier 4 engines in, which that engine package is going to cost, short of $1 million more than a tier 3 sister vessel. So you got a ways to go still in the inland market to get to the point where you can justify new construction and get for those companies that are disciplined and care about a return on capital and operate that way. You're a long way. I would tell you rough numbers, 30 to 40% from current rates to where you need to get to justify building that inland unit. So that should keep a cap on supply here for a while. The rate environment is quite good. We continue to see momentum. It has not plateaued. We'll see where that goes, and we'll enjoy it while we can. But it is very hard to see where the supply side, could screw up this run, at least in the shorter run, very possibly in the longer run. Lead time on an inland tank barge is about, 9 months to a year. But to your point, there's nothing in the order book today. It's pretty unprecedented to your point, especially in the inland yards. You do see some hopper barge construction, so the shipyards are able to stay in business, and there's some demand around the dry cargo, but we do not see it in the tank barge side on the inland side. I'll touch briefly on the offshore side, then let these gentlemen weigh in. Very similar economics on the offshore side. I live in the ATB world, not the MR world. So from an ATB, new construction perspective, you're still a pretty good ways away from justifying new construction at current ATB tank barge rates, even though those are also rising nicely and headed in a very good trend. But I think what you stated at the beginning is right. Your supposition that, the discipline, or if you're going to want a disciplined return on capital, it's going to take a little while for the rates to get to where they are, mainly because of inflation and what this hyperinflation has done to plate steel, electronics, paint. My God, we get a really good deal at paint at Kirby, and I'm paying 25% more for paint than I was a year ago. Wire lines 41%, other rigging 90%, oil filters 123%, communication and radars 172%. So hyperinflation is real. The inflation around what it costs to build the type of equipment we operate is real. So I think it will keep a cap on the supply side here for a while.
Maybe I can jump in and echo some of Christian's comments by adding that for deepwater vessels, tankers, MR tankers, the regulatory environment also adds a really large question mark to any decision to try and make the kind of capital investment that's required for an MR tanker. MR tankers are going to be subjected to IMO rules, most notably the Carbon Intensity Index, which imposes ever tightening regulations on the carbon greenhouse gas emissions that your ship is going to be able to live within. Given the existing propulsive systems, nothing out there right now meets those requirements when you're taking a 20 to 40 year timeline in terms of what a Jones Act asset is likely going to have to be able to survive in order to make the kinds of returns that are necessary. And then on top of that, when you touched on it earlier, if you take a 40-year timeline, what does the demand side look like in 40 years? Maybe gasoline demand into Florida is halved or 75% lower, and then therefore the demand for that kind of transportation doesn't exist anymore. So I put it all under the rubric of obsolescence risk is as great, if not greater than any time in history when looking at technology and equipment. And unless the customers are willing to absorb that obsolescent risk, I don't see many, if any, owners willing to take that kind of big capital bet on what the future will look like. You may see new building in the articulated tug barge sector. First of all, there are more yards, and maybe Dan can talk about yard availability, but there are more yards around the country that can build ATBs as opposed to pure tankers. So there's a little bit more capacity for doing that. But the other optionality that exists is the tugs are not subject to CII, or at least not currently subject to CII. And so you could imagine yourself building a barge, putting a tug in that might run you another, whatever, 8 or 10 years, and maybe you find some other use for that. And maybe when new technology emerges for how propulsive systems for deep water vessels are going to be determined, maybe in 10 years or 15 years, you would build that new tug to be able to continue to barge for another 20 or 30 years. So I'm not saying there's not going to be any new building, but I would be shocked if you see any kind of tanker new building in the next 4 or 5 years, until and unless there's a resounding conclusion as to what the propulsive systems of the future look like. And you might see some ATVs, but not a lot in my view.
Yeah, the only thing I think you guys covered the capital side really well. I think the other thing where rates have to move, not just to get back to replacement cost economics, but versus where people were happy and excited, and I'm just going to talk about MR tankers for a moment here in the $70,000 range 5-7 years ago. Your operating costs today are materially higher, both crew and all the comments Christian made about oil filters. It all adds up, your regulatory dry dockings. So your margin is actually down on the same rates that everyone was excited about. So the rates really have to get to the sort of the marginal cost of replacement returns. It has a ways to go, and part of that includes the underlying operating cost inflation that we've all been seeing. So that's just additive to the rest of what was covered here.
So supply doesn't seem like it's going to be a problem for a while. Demand sounds like it's pretty good, without a whole lot of holes that can be poked into that dynamic. Outside of black swan event risk, is there anything standing in the way of a multi-bull cycle here that you guys can think of, or are you're not losing sleep over really anything right now?
There's always reasons to lose sleep, Ben. But I think the economic fundamentals that you referred to are as positive as they have been in a long time, and we see this cycle as having legs. Shipping has a way of delivering black swans all the time. So I don't sit out there and say nothing can hurt our business. But as I said, I think we're as confident as we have been in a long time that this particular market has strength, and we think that's beneficial for our business.
Yeah, I'll give you a quick thought on black swans and just the resiliency of these businesses. So what do we contend with every day operating these companies? Well, we've got weather risk, we've got hurricanes, we've got ice storms, most recently, that has damaged the chemical and refining infrastructure in the Gulf of Mexico, impacted demand. We got through the pandemic and battled COVID. We're still in a challenged labor market, I think, kind of across all of our companies, but we're all figuring out ways to navigate that and attract the mariner back to the industry. But we have weathered many a black swan event. It's never fun, but we all have our playbooks and have survived them. It is hard to envision something as cataclysmic as COVID. I guess a really deep recession would be a major concern, but again, we would know how to navigate that. And I think the supply side that we referenced earlier would help navigate that. But it's hard to really, again, to Sam's point, I think if you're in this business, you wake up paranoid and hungry and resilient. You just have to be to do what we do. And nothing in the windshield, but none of us ever take that for granted. That's for sure.
Yeah, it's a little scary when it seems like everything's going right sometimes. I've got the 2-minute warning here, but just lastly, and I know that it's going to be discussed in other panels, so I don't want to belabor it, but are you guys seeing any regulatory risk really that is unusual or more than it was, or anything else that might put some of this Jones Act dynamic at risk? And again, we've got 1 minute, so anybody that wants to go.
Can I touch on ballast water treatment?
Sure. Go ballast water.
ATVs. So What you're seeing in our ATB market is a regulatory demand that it's really created a retrofit dilemma for a lot of owners. And it's a high capital and a bit of a tough thing because you're having to re-engineer equipment that was built with a lot of stuff on deck and then figure out how to put a ballast water treatment module. It's more complicated than it sounds. The only positive that comes out of that, it is pushing tonnage out of the business. There have been multiple occasions recently where units have come in for their ballast water retrofit, and by the time the economics are done and the scope of work is done at the shipyard, we've seen some tonnage retire. And so I think ballast water treatment is something from a regulatory perspective to keep an eye on. I'm talking about, sort of the ATB market that I'm operating in, or our Kirby is operating in. But I will touch on that as that's just something to keep in mind and watch. And it's dynamic. There's a lot of units coming up for their required ballast water treatment shipyards. Fortunately, we're through almost all of ours. We have 5 left, and those will mostly happen in this year, and it will impact the year. It's a expensive, long shipyard to get it done. So that is a headwind for sure, and a cost. But we're also seeing it also helps shrink the tonnage.
I'm being told that we're out of time and being given the hook. But how about this? Yes or no? Do you think there's regulatory risk? Sam, yes or no? Binary.
I think CII is something that has to
yes
be,
or no, Sam?
Yes, CII.
Dan?
Yes, but we'll manage it.
Hate to cut you off, but I'm being cut off. I really appreciate it, guys. I appreciate you taking the time, spending it with me, and I appreciate the Capital Link guys for asking me to do it. So
good day.
All right.
Thank you.